Hi, I'm David Buckland, and today I'm going to talk to you about the Aussie resource service sector. Last week, the Bureau of Resources and Energy Economics, also known as BRE, released their biannual Resources and Energy Major Projects Report. And it isn't good reading if you're an Aussie resource service company. According to BRE, the amount of committed project work dedicated to the resource and energy sector has already declined by $40 billion or 15% to $230 billion in the past year. And I reckon this is just the tip of the iceberg. What is clear are there are some enormous projects, particularly in the energy sector, that are or will be coming to an end very soon. They're shifting their status from construction to production. I know of 5 projects with a combined production profile of 50 million metric tonnes a year of liquid natural gas that come to mind. These include BG's Curtis Island, Chevron's Gorgon, which is an enormous project, Santos's Gladstone LNG project, ConocoPhillips Pacific CSG to LNG project, and finally Chevron's Wheatstone project. All 5 coming online over the next 2 to 3 years. As the construction phase of these significant projects come to an end and the amount of committed project work within the resource and energy sector is expected to halve, and I think actually probably halve again. The Australian Bureau of Resource and Energy Economics actually estimates the combined value of committed work is likely to decline by 75% to $55 billion over the next 4 years. There may be an opportunity to sustain higher levels of investment, but projects have to get a lot cheaper. Particularly in the energy sector, there needs to be a lot of productivity gain to approve any new greenfield projects. Australia, of course, will benefit over the foreseeable future from significant increases in volumes in iron ore, coal and particularly gas. Just to take an example, LNG exports are expected to grow 5-fold to over $65 billion over the balance of this decade. However, the crucial point for the resource service sector is that the production phase for these enormous projects requires very few people and relatively little servicing compared with the construction phase. So if you're invested in companies that service this construction phase in the resource or energy sector, look out for some very stiff headwinds over the next few years. I'm pleased to say the Montgomery private fund effectively exited the sector about 2 years ago. And the Montgomery fund has always had, in general terms, a minimal exposure to the sector. Thanks very much. Please continue to follow us on Facebook and Twitter.